around 0.5% there. A third of a percent higher in the mid-cap index is what you have. Nifty heat map gives you a quick sense of how things are opening up on the index. And what do we have? Tata Consumer on one end, and they've got SBI Life on the other end, which are starting. But it's overwhelmingly up and about. Remember, the Nifty yesterday took out the prior high, the previous high. It's taken out all, daily and hourly averages, etc. So maybe a bit more extension here. 25,500 or so, the first stop. 25,300 for now, with about a 60-odd point higher start as we begin today's session. Surbhi.
Okay, Tata Consumer, top position. Yesterday, the company announced that it will be offering the price benefits on its tea portfolio to customers. Not sure that would be the lone reason why the stock is up 3%, but it's a big mover today. The other one is Coal India. Coal India has emerged as the top bidder for a rare earth block. Market's getting a little excited about that. 1.5% up on Coal India. BEL is continuing its good form from earlier this week, 1.5% higher. Ultratech Cement, along with a bunch of other cement stocks actually, because of positive brokerage commentary. Some of the others like Shree Cement, etc., are also up and about. Then what do we have? We have Tata Motors, Trent, Grasim. There's Infosys. So it's pretty mixed. There's also Reliance, there's Maruti. So really lots of legs to the market up move, 50 points higher, and overall looking good. On the flip side, let's see, Adani Ports is cooling off. Pharma is not in favor today for sure. Cipla, Dr. Reddy's and Sun, all these stocks are down. But that's about it. Some pharma cool off. Otherwise, most of the Nifty constituents are nicely chugging along this morning. Nigel.
Well, that's right. Just keep an eye out on a few stocks, that are moving higher on decent volume. Skytex Garments, the stock is up closer around 4 to 4.5% or thereabouts. Year to date, it's still down closer around 4%. But good pop-up is what we are seeing. Reddington was one of the stocks that moved very, very well yesterday. Today as well, is building onto the gains. It's up closer around 3%, one of the top volume movers. Aditya Birla Fashion, they have launched value retail brand owned. They plan to open close to around 100 stores. The street likes it. One of the top movers today. Belrise, Investec had come out with an initiating coverage note. And that's why, in fact, you have that stock as well that's reacting to that piece of news. Keep an eye out on a couple of these names like Gokul Das as well as Wellspun Living. When you see some bonhomie between our Prime Minister, Mr. Narendra Modi, as well as the US President, Mr. Trump, then these stocks, after getting hammered when the tariffs went to 25% and then from 25 to around 50%. So there is hope building up out there. That's why Wellspun Living as well as Gokul Das, both of them up and about in today's trading session. On the flip side, Gujarat Fluoro, the stock is down, is because that large trade was awaited. That's got cleared out of the way, down close to around 2.5%. You have Mobiwick, that saw a big rally. That's cooled off a little bit. But otherwise, a decent opening to kickstart trade. 25,300, the bulls will be thanking their stars.
Absolutely. And there is suddenly some sort of life and vigor which we are seeing in markets, at least at index level. Otherwise, it's been about single stocks, and there have been so many 50, 60, 70% kind of movers, but the index, of course, has not gone anywhere for about 14 months now. This is the 14th month in that sense. Rana Gupta is with us. He's Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. Do you think what we've seen, this 800-point move, is the so-called tactical rally in anticipation of some kind of a deal with the US? When I say a deal, I don't mean a full FTA, BTA. I mean this 25% getting knocked off. Or do you think if that were to happen, then you will get a tactical rally from here? What's your sense?
I think let's step back a bit. I think the market is in the 24 to 26,000 range for last 1 year now. As the earnings cuts have happened and then the domestic economy has moderated somewhat. But going forward, we see there's a GST cut, income tax cut in February, RBI rate cut, adding up to the stimulus side, which kind of nearly offsets the headwind from US tariffs. From here on, if US tariffs were to go down, then this will turn into a net stimulus, and that could be pretty positive for the economy as well as the markets in our view.
Okay, so from here, what will you watch, Rana? Is it just a game of waiting till growth picks up? Or are there any indications? I'm sure post the 22nd next week when these cuts go into effect, the street will want to see across product categories, consumption-wise, where are things picking up to expectations, because many of these sectors have reacted already in that sense.
Oh, absolutely. So I think, irrespective of the rate, if and when US tariff goes down, it will be net positive to the economy. And even before that, even if let's say that were not to be the case and tariff were to stay at elevated 50 or 25% level, the government has given significant incentive through income tax cut, GST rate cuts. So therefore, we believe the following three sectors or subsectors should see benefits, and that's why we are watching. Number one is auto. Auto is interest rate sensitive. Plus, for the last 2 to 3 years, barring SUVs, the sales have been pretty flat. So we expect definitely momentum to come back in that segment. Second, I think as a result of price of essentials going down, we do not think a person buys more of toothpaste and more of tea and all of it, but the savings on essentials can be spent on things like, let's say the food delivery, quick commerce, buying insurance products, or travel. And here, some of the internet platforms have very dominant presence. And third, in consumer durable. And we prefer playing the consumer durable through the manufacturing route. And also in the past, we have discussed that consumer durable electronics, these are growing areas, and how Indian companies are garnering more share by manufacturing in India. So that's the EMS part, that's also we like.
Okay. By the way, just looking at some more stocks on the move, Reddington has started its run again. Yesterday, it was a 20% move. Today, it's 4%. Not sure if this is just sentiment ahead of iPhone. I think it's 17, right? The latest one is 17. Those sales, I think, kick off here in India today onwards. I'm not sure if just sentiment driven or something additional. But that's one for sure. Credit Access, about 3% higher. Watch out for the exporters. Gokuldas Exports is soaring 5% higher on this expected breakthrough, some sort of a breakthrough in those tariffs. And Gokuldas is definitely on the move. Rana, great to have you in. On the exporters, actually, let me take up that piece. How do you look at them? Because the thing is, they're high-risk sectors, given all the tariff talk, whether it is your shrimp exporters. And, we had favorable news coming in from the EU, and the shrimp exporters completely went through the roof for two sessions. And there are the textile exporters, apparel exporters. Do you like this space at all? Are you playing it or totally avoiding?
So for investors like us, we like a bit of predictability, stability, and some right to win. India's textile export, while competitive, agriculture and other exports, they face stiff competition from some of our neighboring countries. So therefore, I think when the tariff goes up, they will react negatively, and the tariff goes down, they will react positively. Underlying business is perhaps stable, but the stock price are not as much. So therefore, what we prefer among triple exporters are the companies or the sectors where India has a right to win. And you can think of sectors like pharma, CDMO. In the small molecules, I think a lot of CDMO activity happens in China, circa 90%, and that's very high. And logically, even without going to geopolitical reason, I think there is reason when a country or a geography accounts for 90%, you begin to slowly diversify. And outside China, perhaps a bit of South Korea, India is the only place that can have that kind of domain expertise, which can support that kind of shift. So there, I think we like, and because this sector, India has a differentiating edge, and it's pretty difficult to compete with the Indian expertise, cost structures, and the product quality. So that's one sector on the export side we like.
All right. Hi, Rana. Good to see you in. What are the odds, though, give and take everything, after India's recent underperformance? Do you think, that premium as well that we enjoy in comparison to the other emerging markets, well, that's not a little bit, right, post this spate of underperformance. But we're still at around 55% premium in comparison to the peers. Do you think from here on, if you have a 12 to 18-month view, Indian markets will relatively outperform after underperforming?
I think from here to 12 to 18-month view for Indian markets to come back to our performance, that tariff where India is ahead of India is worse off as compared to the Asian countries need to reverse. Most of the Asian countries are in 15 to 20. It needs to come back to at least that much for Indian market performance to resume. But let me add a bit more color to the India's underperformance and what's really going on. If you look at China and South Korea and Taiwan, the markets which has done well, or even Singapore for that matter, there are two legs to the story. One is AI, and second is the government or the regulator doing some terms of juice up or doing some value unlocking or giving some stimulus. In India, the AI leg is missing. Of course, the government leg is now kicking in. Now, emerging market investors' portfolio cannot be only AI. they would want to be emerging market consumers. And for that, India is the best place to go. Now, if the tariff remains high and given the stimulus given, I think India consumer and that sector will remain an attractive place. But once the tariff rolls back to in line with other Asian countries, I think then there is a case to buy other sectors, including the financials and the exporter sectors and all of them. So in short, I think even without tariff, Indian consumer sector looks pretty good. And for Indian markets to come back to our performance, I think the tariff needs to come down at least to the other Asian markets level.
All right, let's talk about the BFSI space then. In the past, I think we have discussed about that the NBFCs are a space that you like in comparison to banks. How are you positioned right now on the banking and financial space? What do you like out there? And between NBFCs and banks, and within banks, PSUs versus private. Your take.
So in the BFSI space, with the RBI rate card, we were quite positive on the non-banks as well as the private banks. On the non-banking side, we continue to remain positive on the large companies. Albeit, I think in the smaller non-bank NBFCs, which lends to as a commercial vehicle or micro lab or small SME, there is stress, and there is no denying that. So NBFC, our view is pretty nuanced. I think the larger ones are okay. The smaller ones will still face some asset quality challenges. Something like a microfinance seems to be coming out of it, whereas the small lab, small SME and single CV and all that, they seem to be going into it. So again, one has to be very nuanced in which non-bank one has to go. Bank, we have continued to like the private banks. And I think as the consumption picks up, private banks will do well. See, private banks kind of underperformed in the later half of the Delhi last year also because the government stimulus policies were towards the industrial side. And industrial side benefits the PSU banks much more because they are those corporate capex lenders. Whereas if our thesis is right, and this time round, the rally, at least initially led by the consumer sector, we do think the large private banks are at a pole position and they should do well. Their balance sheets are solid, their return ratios are good, and the valuation is not excessive. So we continue to like the top private bank space.
Yeah, no, absolutely. Just a bunch of other names, right? We got about 4:1 in terms of advances to decline ratio, and it's looking looking pretty solid in the broader market space. Even though for the Nifty it's about 50 points so far. Maybe just a few names, right? Reddington had a big day yesterday, and it's up about 1.25% this morning, but it's got the largest volumes in the NSE. Persistent is up about 3%. Persistent coming up with large volumes again. There is a 17% move on what is this? Platt IND but it's got the third largest volumes in the NSE. We'll try and see which one this is. Aventel is up about 2%. Tata Chemicals is up 3%. KRBL, we spoke with the management, I think, day before yesterday, 2.5% higher in KRBL, 414. Premier Explosives, big explosive move, 7% higher on tremendous volumes as well for this point in the day. And you'll see that coming up on your screens. There's Wellspun Living, about 6% gains here. Gokuldas, of course, back above 800. And I can go down the list. There's Castrol, KNR Construction, Mahindra Life Spaces. It's picking up quite nicely in terms of volume-led gains. Credit Access, just looking at Credit Access, the low in this year was about what? It's basically not doubled, but low was about 750, and stocks, 1350 now on Credit Access. So big one from the lows coming through on that one. Rana, just a last quick word on this entire data center opportunity. We've been having this discussion last couple of days. Any stocks here that you own in your portfolio on the back of it? That is the pointed large theme, the reason why you own a name.
So data center is, of course, a big opportunity, but the data center requires a lot of capex. And we think, based on our understanding in India, what's happening, the larger players are going to win. In terms of if you want to distill it down to the stock, it will be these companies are very large, one of the largest groups that you can think in India. So how much data center will add to the stock price is a matter of debate. Nonetheless, I think the larger telecom companies in India, they are doing very well in data centers. And going forward, as data center revenue picks up, they will become a quasi data center kind of a play going forward. But right now, the contribution of data center in the total valuation is quite low, but is going to increase over a period of time.
Okay. All right, Rana, we'll leave it on that note for this morning. Thank you very much for joining in and giving us your perspective on the market. Well, before we introduce our next set of guests, a couple of other stocks that are worth noting. Let's pull up IEX. IEX has actually gone ahead and challenged this market coupling order. Remember, I mean, that's sort of pretty disappointing for their business because they lose their monopoly on the power exchange business. And now the company has filed an appeal. Let's see where this goes, but that stock's on the move. The CLSA note on cement that Sudarshan was talking about earlier, that has been noted and picked up by the market as well, because most of the stocks on which CLSA has a positive view, either an outperform call or a positive call, they're all up and about, starting with Ultratech. Shree is also higher. Dalmia is up about 1.5% as well. So some of these stocks are in focus. That's on the upside. And on the downside, I just want to point out Dreamfolks. I mean, it is little to say now, but it's just been a very painful journey for investors. Same time last year, 1 year back, Dreamfolks used to be a 500 rupees stock. Today, it's under 150. The entire business model has been completely, is decimated, too strong a word? Maybe not. It really has been in this case, at least. Well, with that, let's move on. Do we have our next set of guests with us? I think we do. And of course, we are talking about Prime Minister Narendra Modi's 75th birthday. As we've been noting, of course, greetings have been pouring in from across the country, around the world. Political leaders, party workers, citizens, all of them expressing their wishes and gratitude. And of course, India is on the global stage, on the global map, navigating some pretty important headwinds, including, of course, those US tariffs as well. Our colleague Shivani Bajaj is here to understand and take us through some of the most important economic reforms and economic policy measures that have been undertaken under Prime Minister Modi's leadership.
Well, yes, Narendra Modi's 3 terms as Prime Minister have been defined by bold, large-scale economic reforms aimed at making India a modern, digital and globally competitive economy. One of the first big reforms was GST in 2017, replacing dozens of state and central taxes with a single one. This created a common national market, reduced evasion and simplified compliance, especially for MSMEs. At the same time, Jan Dhan Yojana brought over 450 million bank accounts into the system, enabling direct transfer, digital payments and true financial inclusion. Combined with ease of doing business reforms, India's global ranking jumped from 142 to 63 in 5 years. Now, in the second term, reforms went deeper. The Insolvency and Bankruptcy Code cleaned up the banks, while Labour Code simplified over 40 laws into 4, balancing worker protection with global business needs. During the pandemic, Atmanirbhar Bharat and PLI program boosted local manufacturing, agriculture and MSMEs, generating jobs and reducing import dependence. And then a 1 lakh crore rupee R&D fund further fueled startups and high-tech innovation. Now, in the third term, the focus is on future technologies and sustainability. The semiconductor mission is building a chip ecosystem, while the India AI mission, with over 10,000 crore rupees of outlay, is powering startups and research. Simplified income tax rules, an ambitious clean energy goal of 500 gigawatt by 2030, and also the EV policies are positioning India as a global green tech hub. So from GST to Jan Dhan to PLI, AI, semiconductor and clean energy, PM Modi's reforms are deep, structural and future-ready. They empower millions of entrepreneurs, innovators and workers, laying the foundation for India's long-term growth story. Back to you.
Okay, well, those are, of course, just some of the many, many reforms and policy measures that we've seen over the last decade or so. Let's take this discussion forward. We have 2 experts joining in. We have Mr. T.T. Ramamohan, former professor of finance and economics at IIM Ahmedabad. And we, of course, have with us Mr. Sanjeev Sanyal, member of the Economic Advisory Council. Gentlemen, good morning. Thank you so much for being with us. Sanjeev, if I could open with you, we're having this discussion at a very, very interesting juncture. It's also a special day for the Prime Minister, right? And what better than getting a greeting from his quote-unquote friend, Mr. Donald Trump. How do you assess how India has navigated the last couple of difficult months where there is, we're at an intersection of foreign policy objectives, defense objectives, economic and trade objectives, and the need to spur the domestic economy against headwinds? How do you rate the response so far, and what more should citizens and investors expect?
So if you see how we have responded to this entire tariff thing, you will see our policy has been very consistent. First of all, we have never escalated the matter. At the same time, we have stood our ground. So we think we are being reasonable, and we are not going to bend. Many other countries have, but we have not. But as I said, we have at no point escalated matter. Whenever we have had a friendly overture, we have seen Honorable Prime Minister respond positively. So the idea here is that, look, as a rising power, we need to signal to the rest of the world that we can stand our ground. I mean, quite apart from standing up for our own interests, as we also need to show that, we are a power of some standing. And in that sense, we have, as I said, signaled clearly where the red lines are, and we will stand by it. So I think this is not just a issue about tariffs or standing up for Indian interests. I think what it signals to the rest of the world is that India is now no longer a pushover. And at a time when major economies like Japan, like the European Union, and many others have been quite happy to bend over, we have not. So I think in that sense, this is a very important geopolitical move as well.
But Sanjeev, the other part to my question, the domestic response, while we've stood our ground internationally, we've chosen to perhaps start a sort of dialogue with China. The GST cuts here, a different approach by the RBI. Is all of this enough, or does the economy need more at this point?
So what I will say is that, look, the economy has good momentum. Growing at 7.8% in the first quarter came out stronger than I expected as well. But the fact is that this is being achieved without any macroeconomic instability. So inflation is, in fact, at the bottom of the MPC's target range. The current account is basically flat, 0.2%. Deficit is nothing much. We've just recently got an upgrade as well. The banks are in rude health. So if we cannot take the pressure from the negotiations now, when are we going to do it? So I think we are in good shape on that front. If the economy needs some more support beyond the GST cuts and other things we have done recently, we have even more ammunition in the pipeline. I mean, we can do things on the monetary front, on the fiscal front, and of course, we are continuously doing ease of doing business and other reforms. So, we do have more ammo in the pipeline, and it will be used.
Gentlemen, morning. Prashant here. Sanjeev, and I think you've spoken about process reforms, right? Lesser talked about, but having an outsized impact as and when they happen. Just a quick word in terms of just are we, Sanjeev, finally seeing, and I think across, when we speak with bankers and people who fund the economy, both banks, NBFCs, etc., they all say that one of the things which needs to perhaps be focused on now from a domestic perspective is, this K-shaped recovery which began in 2020. That is, I mean, we're still seeing a continuation of that, and banks and we can see credit growth numbers, etc. They've kind of sort of dropped off at the mass end. You can see it across sectors, across categories. Is the focus now shifting to that segment in a big way, Sanjeev, in your opinion? I just wanted your thoughts. First, shift from infrastructure to consumption. Of course, it's going to be both, but maybe a little bit more on consumption now. And then at the mass end.
So what we need is a balanced growth. But I disagree with your idea about K-shaped recovery. I think the recovery was fairly well balanced. And I think we do need to push for more productivity and efficiency. So if you're thinking of the GST reforms we have just done as purely a consumption push, then you are mistaken, because essentially at the first instance, the real benefit of that is that we are removing the frictions in the system to basically keep growth going. Now, it also benefits consumption, but the idea is not merely to boost consumption. The idea is to make the system much more efficient. And we have been always consistent, is that ultimately what you need is job growth. And job growth comes from higher economic activity. There is no such thing as jobless growth. That in history of economics, that's never happened. So sustained growth over long periods of time is what generates growth. And we have seen that as we have recovered out of COVID, that sustained growth has in fact caused the inflation rate to come down very significantly. And despite the fact that India is adding, because of its demographics, millions of people into the workforce every year, we are able to absorb it. Now, maintaining this growth momentum is absolutely critical. And so while, yes, we will do demand management, obviously, but making the country more efficient and making it more competitive in the global scenario, adding ourselves to the global supply chains, these continue to remain critical things that we are thinking about. The supply side is, in the long run, far more important than demand management.
All right. Good morning, gentlemen. Good to see you all in. Well, Mr. Mohan, coming across to you. Under our Prime Minister's leadership, will India scale digital inclusion, infrastructure, global stature as well? The road ahead is going to be important, though. We need to sustain this high growth, quality jobs, private capex, maybe some more deeper reforms as well. Trade, manufacturing, finance, that's top of mind. How would, what would you say about the last few years for India? And what's top of mind in the next few years?
Well, the record of the last 3 years is clear enough. We have recorded growth of 7.8%, which is way above anything that any analysts and commentators had predicted. So I think one of the things that is notable about the performance of the present government is that it has consistently produced surprises. I think one of the biggest surprises was that we entered COVID with an NPA level of, I think, close to 6%. And the betting was that with a shock of that sort, the NPA level was bound to go up in the system. What else do you expect? But lo and behold, the NPAs actually started declining post-COVID. So I think I think this government has developed the necessary macroeconomic tools to deal with crises of various kinds. And I think it is somewhat premature to talk about sweeping reforms at this point, because what we are facing now is a situation of unprecedented certainty. It's very difficult to for private investors or even for the government to plan very far ahead until the entire tariff regime settles down. And the priority in this system, the priority in this situation for the government must be to reduce uncertainties of any kind. And here we are very well placed because we are looking at a growth forecast of 6.5%. And if the present tariff regime remains in place, which is 25% plus 25%, we are still looking at something like 6%. And given that this is the baseline forecast, and we have plenty of flexibility on the monetary side in terms of monetary easing and fair degree of flexibility on the fiscal side, I think we are very well placed to respond to this situation. But I think one shouldn't be in a hurry to roll out reforms because many of these reforms are sector specific. And it'd be very difficult to have a clear view of what precisely reforms are needed until the situation settles. But the model that we have followed so far, which is that the government takes the initiative in pushing investment, particularly investment in the public sector, particularly in respect of infrastructure. Now, this is an approach that paid off very well during the COVID crisis, and it was backed by liquidity support for private enterprises as distinct from fiscal support. So I think that is a model which we should broadly adhere to in the present situation till the dust settles down.
Sure. Okay. Gentlemen, I just wanted both of your comments on our engagement with China. And while, of course, we work with the US side to see if there can be a de-escalation of sorts on trade, the other, important segue that opened up after the SCO summit was the way we will engage with our neighbor. Sanjeev, your thoughts here, and I'm not getting into the foreign policy and the security aspects of it, but purely in terms of having a trade relationship. We know about the high surplus or the high deficit we're running with China. And then there is the Indian industry, which is used to a high degree of protectionism from everything Chinese. Has the time come to change that? Are we ready? What would you advocate here?
So I think here we have to take a balanced approach. On one hand, we have been very clear that we don't want to join RCEP, for example. But on the other hand, the fact is you can't wish away China. China is the source of a lot of inputs into things in which we are planning to be a part of the global supply chain. So if you want to be a part of the supply chain, you cannot wish away the fact that China is such an important supply of all these inputs. So in that context, I think the idea is that we be pragmatic about it. Where we need their inputs or even investment, we should find ways of engaging with them. But at the same time, we have to say that there are interests that we need to protect, and those should be protected, which is the reason that it's probably not a good idea to get into something blanket like the RCEP. But yes, the fact that we are now seeing a normalization of relations with China, starting with the Honorable Prime Minister's recent visit to China, I think that's a step in the right direction.
So many more questions, and we'll continue this discussion, and we'll invite both of you back on this program. For now, thank you very much, Sanjeev and Mr. Mohan, for joining us here on this program on this special day. Well, I just want to quickly make a mention of Urban Company, which has made its debut. So I think the pre-open is settled in terms of the listing. The price has been found, and those are shots which are coming in straight from the NSE. I think these are pre-ringing the bell shots which will come in at 10 o'clock when the stock starts trading. But we should put the flash up. I think it settled at about 162 rupees. And they sold stock at 103 odd rupees or so. So that is Urban Company listing. I think, 100 times subscription? There you go. That's what I'm talking about. 161. 56% premium on top of the issue price. We'll take a quick commercial break here. We'll come back more on Urban Company, but also we'll go to the Jefferies conference, which is happening in Gurgaon. Peter Forlenza and Ashish Agarwal will be joining us from the sidelines of the conference with what the investor mood there is. Stay tuned. Welcome back. So we've got the market, which is up about 80 points, 25,320 is where we are at. Well, let's go across to the Jefferies conference, which is underway, day 2 in Gurgaon. It's a big one, a 4th investor conference, India conference for Jefferies here. Peter Forlenza is Global Head of Equities at Jefferies. Ashish Agarwal is India Country Head at Jefferies India. Gentlemen, great to have both of you here. Appreciate it very much. Ashish, let me get a quick sense from you. I mean, what's been the feedback so far, and what's the one question you're getting most from investors, and if you're getting some questions from corporates who are there as well?
Thank you, Prashant, for having us. We've got We've got off to a great start. We have almost 270 odd investors at the conference and about 120 companies presenting, a variety of topics ranging from capex to AI to consumption, everything. The one question which is definitely on the top of every single investor is when will the capex cycle from the private side revive, and what will be the impact of consumption from the GST cuts that the government has announced. Indian markets have been sideways for the last 12 months since our previous conference. Relative valuations for India have corrected meaningfully. So every single investor is looking for when India starts to participate or drive the EM rally that we have been seeing in some of the other emerging markets.
That's well put. Peter, just give us the global perspective. I spoke with Chris yesterday, and he was saying that the big $28 billion that foreign investors have sold in India since the peak in September 2024. I mean, his point was it's all relative at the end of the day for global asset allocators. I mean, people have been chasing Taiwan, Korea, China earlier, on the back of valuations here, which have been expensive. Where are we, purely valuation-wise? I mean, growth has to pick up. Nominal GDP growth has to pick up. And hopefully with these three things, 2 tax cut and 1 rate cut, it will happen. It will start to, come into view. Maybe second half or maybe next financial year, we'll have to wait for it. But as things are, where are valuations now, Peter? And is the valuation problem, are we close to sort of crossing that hump?
Why don't I speak a little bit about not just the valuation, but investor sentiment that we've seen really since mid-23 globally in the markets. I'm fortunate that I spend a lot of my time traveling the globe and speaking to global investors. And if I think back to kind of mid-23 into early 24, one of the main themes was from global investors, the current concern not only of the performance of the Chinese market, but the volatility of that market. And it was clear that fund flows were going to move out of China into other markets. And those themes were really three. One was the Mag 7, money was moving there in the US, but it was also into Japan, given some of the reforms, and very much into India, which I saw getting more attention than I had previously seen in years. And we had global investors that were doing a lot of work on Indian companies and the Indian market. There was some concern on valuation at that point. It's interesting that, as Ashish said, the market here has been largely range-bound since our conference last year, which happened to have been the peak, I believe, of the market for last year. And we saw money leave India and head back into China. I would call that more of a trade. Where are we now? Well, if we look at valuations, the market right now is not trading at historic highs, and actually the premium versus the MSCI EM baskets is right where it historically has been. So I believe we're set up right now for a time for investors, and I've seen it here at the conference, who have come into India, who have not been here before, who are now trying to learn more about India, and they're seeing the growth. And importantly, what excites us is the amount of companies that are coming public, which is something the world needs.
A very interesting perspective.
What Pete just mentioned.
Sure, go on, Ashish.
So I think, even China markets and Korea markets doing well is probably a great thing to happen to the EM asset class as a whole, because last few years, the only market that was probably driving the EM rally was India. And we have seen a lot of outflows from EM funds. Given what has happened in the last 12 months in other EM markets, we are now starting to see, and a lot of investors have been talking about it, inflow of funds in EM markets. And of course, India also stands to benefit, rising tide lift all boats kind of a thing. So in a way, I think China and Korea doing well is also good for India.
Okay, that's a valid point. Take that point. But, let me ask you a bit of a counter. Peter, I heard your perspective, and that's great. But what I want to ask is that it's very clear that India cannot offer, as of now, in a very big, decisive way to global investors, tech or AI. I mean, you don't come to India to play tech or AI, right? So what are you telling global investors at this point in time? Why should they come to India? To play a bigger part of the consumer story? Do you think that's kicking off or reviving in a big way? Or is it going to be more about manufacturing, the whole China plus one, realignment of global supply chains? What's the narrative, and why are you telling global investors to look at the Indian market at this point? Peter?
Well, I think the narrative begins with India is now the world's fourth largest economy, heading to be number 3 with an emerging middle class, with an entrepreneurial culture where we have many companies that will be high growth companies that are coming into the market. The world is looking for new companies. Again, I would argue that we globally are overweight a lot of the, I would say, not just I'll be more specific than the broad Mag 7. You've got the hyperscalers plus NVIDIA. The world has been overweight that. We did see money go into Europe this year. But when you look at India, again, a growing economy, a populace that has an emerging middle class, that has a fantastic education system, and again, has this entrepreneurial culture. So it is a place that will continue to grow. And again, we're going to have more exciting companies to invest in.
Peter? I think from our conversations with investors, I think one of the things that is also coming across is last 20 years, India has been a pure consumption story. And the biggest pushback on India has been everything works, but infrastructure needs a massive upgrade. And at this point of time, we are on the cusp of a massive infrastructure upgrade. And it's a sector which has huge growth potential, be it ports, airports, power, hospitals. And all these are sectors which offer tremendous runway for growth with strong earnings. And that's what is exciting investors to look at India beyond consumption alone.
Ashish, I know you're doing lots of these feet on the street kind of trips over the last, yesterday, today, and I think tomorrow as well, right? Showing investors some of the infrastructure projects in and around Delhi?
Well, everything, right from consumption to infrastructure. We've taken them to power plants, we've taken them to some stores. So yes, trying to give them a real look and feel of what's there on the street and not just in the conference rooms.
Yeah. Peter, just one question. Is the lack of AI, pure AI kind of plays in India, and because that is where money is gone in very, very large amounts, maybe some people are now starting to argue that it's too much now. And for example, Chris was yesterday saying that most likely this is not going to end very well. There's going to be huge capital misallocation, etc. I don't know if you share that view, but that's not the question. But in India, the lack of those opportunities, is that a bit of a disadvantage on an overall market perspective?
I would say, look, and I appreciate what Chris is saying about the CapEx investment into AI. I think that that story is yet to be written. We will see. When you look at India and the transition that Ashish has been speaking to, I don't think folks are looking at India at all as an AI play. And again, it will affect the services industry. But again, there are many other investments here in India that are attractive throughout infrastructure, consumer, et cetera. I think you'd agree with that.
Yeah, I would agree with that. In fact, Prashant, beyond the infrastructure theme, we are also trying to deep dive into some of the emerging themes. So our research team has put together an in-depth report on AI, the implications and the opportunity for India. Also something on semiconductor. So yes, we are slightly late in the cycle, but I would not go to the extent of saying that India will not play any part on the AI in the longer term. We may not be the leaders, but we'll definitely have some companies. Ultimately, it's data from 1.4 billion people that will also go as an input for some of the AI models. So I'm sure we will have companies coming out of that theme at some point of time in the near future.
All right. Hi, gentlemen. Good to see you in, both Peter as well as Ashish. Ashish, coming across to you, though, on the fiscal as well as on the monetary side, we have seen a lot of support. And now the economy needs to revive. Second half of the year, in all probability, seems to be good. But what more are you factoring in, either in terms of monetary, support or maybe on the fiscal side as well? Do you think there is more headroom, or do you think most of it is already done?
No, I think the government has been very, very proactive in reforms and giving the corporate sector what it needs to thrive and to start building. I believe the relative cost of borrowing in India has never been as low as it is today. given the interest rates having gone up in the rest of the world and India continuing to stay low with low inflation. So I think the opportunity or the backdrop has never been better. What we probably need is the corporate sentiment on the capex side to come back. So the government has done its bit. Can there be more reforms? There can always be more reforms. And the good part is, I think we do get a feel that the government is continuously working on what can be done better. But I think at this time, the baton is more in the corporate's hand to start reviving the capex in a more meaningful way, taking from where the government has done capex so far.
Sure. Okay. Gentlemen, I think the company that has listed today actually is a reflection of exactly what you gentlemen are saying, that there are enough opportunities in India. We may not have, technical, pure AI. Look at that listing, 62% pop. Urban company, which runs that platform, which offers everyday services, came into the market to raise about 1,900 crore rupees, and investors have welcomed it with open arms. And we have lots of celebrations there at the stock exchange going on right now. We'll keep getting you more inputs on this in a bit. But yeah, I completely take your point. I mean, Ashish as well as Peter, that you don't necessarily have to be in the most complex business. Even if you're selling, butter, cheese, whatever, if the business works, then investors want a slice of that. And that's what we're seeing. Peter, just a question on whether geopolitics, this whole India-US standoff over the last couple of months, if that at all is clouding the investors' decision making. Now, of course, there are better overtures. Some bonhomie started. But is that at all even a factor when people are looking at allocating money to India?
Yeah, I do think it is. I think it affects investor sentiment broadly. And I'm hopeful that it will be short-lived. I'm hopeful all of this will be short-lived. But I think it's much more sentiment on when they actually start making the investments. It may cause a bit of a pause, but I believe that will be short-term, much like it has been in other markets that we've seen, kind of a pause, if you will, in investment. I think once we get through the other side of this, the themes that we've been speaking about are very much in place.
So if I were to ask you, Peter, say over the next year or so, till the next conference, which would be India's biggest, competitors when it comes to vying for foreign flows? Last year it was, the year before it was Japan, then it was South Korea. It's been China to an extent. Next 12 months, who's our biggest competitor in terms of getting those dollars?
Well, I believe it's the same. I believe it's the same markets. I'm still having a lot of discussions around Japan. There are some, again, that we've highlighted about Korea. Recently, that's been less so. Europe had its moment in the sun, if you will, kind of mid-year on certainly the German fiscal reforms, the investments in defense, and the moving off of zero bound, on the financials. So those were themes, but the India and Japan theme, to me, remain the two major themes, and I believe we will be talking about the same thing this time next year.
Okay, as you put it, last time it was a bit of a turning point, almost was the last conference, right? When September was the high for the market here. Ashish, just to distill down top interest sort of sectors as you see it from here out, from an investor point of view in India.
I think financials, of course, continues to be the most talked about sector given the sheer amount of ownership. But the good part is investors are also very open and receptive and engaging on the new themes that are emerging. As I was mentioning, hard assets, hospitals, airports. We've seen a lot of traction on airport stocks conversation. We're seeing a lot of interest on the infrastructure theme, telecom and power as an overall space, right, from generation to transmission to distribution. So I think some of these sectors are getting added. Consumption, of course, continues to remain at the top of the mind given the GST cut. So I think it's very broad-based. But the biggest question is, do we stick with the traditional growth sectors like financial staples and tech services, or we diversify into the new growth sectors, which is infrastructure and hard assets?
And maybe it's a mix of both, but both very much in focus, as you say. Gentlemen, we'll leave you to it. I got a busy day ahead. Ashish and Peter, appreciate both of you coming on CNBC-TV18 with your perspective, mix of India and, of course, the global view looking into India coming through. We'll take a quick commercial break here. We're going to come back and put the spotlight on commodities as always. Manisha is here to help us with that. Stay tuned.
Back, let's talk about the biggest headline of the day and water listing by Urban Company. 67, almost 68% higher. The shares were offered at about 103 rupees, and look what happened. Mangalam, we were just discussing this with the gentleman at Jefferies, right? You don't have to be in the most complex business of data centers or AI or whatever. You run your business well, even if it's consumer, and you price it well, and the market will give you such a warm welcome. But tell us more, just remind back, what's led to this kind of a huge pop today?
Well, it's a couple of things. One, the underlying TAM or the total addressable market is strong enough. And in that, this company enjoys the pole position of being probably the only one. So this is a market which is nearly 100% unorganized, sub 1% organized. And in that sub 1% organized as well, majority of the share lies with Urban Company. There is no real listed player here, forget listed peer or unlisted peer itself. And add to that, there was a big listing which was expected anyway, because it was a 1900 crore IPO. The issue was subscribed 104 times. So there was strong demand for this IPO. Total subscription 103 times, investors 39 times out there as well. And the most interesting thing for me was employees. So the employees of the company, they filled into the IPO, and that portion itself got subscribed by around 37 times. So when the employees of a company go ahead and, you know, make their inroads for the IPO or make their offers or bids for the IPO, it tells you that there is a strong listing which is expected. So now at closer to 171, the market cap of the company is around 25,000 crores. They offered the company at around 15,000 crores, or nearly $2 billion as market cap. The only thing we'll have to watch out for are the valuations, because remember, basis what the analysts are expecting, if the revenue compounds at 35% as the management has been guiding, even if the adjusted EBITDA doubles from 1.7% all the way up to 3%, and the net profit that the company posts on a sustainable basis reaches about 250 crores, then it's trading at 101 times price to earnings. But then again, if you're growing much faster than the market, then who's to say that there is no upside to the estimated EPS as well for the company. The two triggers that I'll be tracking for them, their core margins, how they expand from here on, and secondly, the native business, which is growing for them. They are looking at becoming a full stack hardware supporter and supplier as well. If that business breaks even, then that could add further legs to this company. So let's watch out for Urban Company. Currently, on the day of IPO, because of strong demand, there is that fear of missing out. So that's why the stock's moving higher. Let's see how it sustains going forward.
Right now, already at 100 PE, right? Forward PE.
Yeah, currently 100 PE. It was offered at around 60 PE. Now it's at around 101 PE.
Okay, all right, Mangalam, thanks very much for that. So it's Urban Company in focus. Commodities next. Manisha is here with what is top of mind. Manisha, morning.
Morning, and thank you for that, Prashant. Well, I will talk about the lead up to the 25 basis point rate cut that the markets have already factored into the space then. And this is not something new. It's not going to be a surprise. The surprise is if he does anything less or more than that, that is the Fed Chairman Jerome Powell. But ahead of that, we have seen this constant decline in the dollar index, trading now below 97. It is a 2-month lows coming in for that. So as I said, 25 basis point rate factored in. And the street is also looking at more US Fed rate cuts in this year and the first quarter of 2026 as well. So there are some 4 or 5 being talked about. That is what the street is as of now haggling about. If you look at the currency markets to begin with, of course, the Indian rupee continues to hold around that 88 mark. But the global currencies also have surged given the fact that the dollar has continued to see a decline. So when you look at the euro, it's trading at a 4-year highs. You have a 4-week highs coming in for the Japanese yen. It's a 10-year highs that you're looking at in Swiss franc right now. The Danish krone trading at a 4-year highs as well. So many of these high-yielding major currencies, the G7 currencies, are trading quite on the stronger note there. The Canadian dollar at a 1-month high. Swedish krona is doing 3.5-year highs on the screen right now. And you have a Brazil real, which is trading at a 1-year highs. That's all that I could fit in sense of currencies. But there are more and more currencies in the G7 and the Western world, in the European markets as well, which seem to be doing quite positive to that run up to the US Fed meeting there. I also want to talk about the gold prices because we are looking at a 41% of gain in this commodity in this year until time. We've seen an all-time high at $3,700 an ounce as well. And much of the gain really has come in the last couple of months itself. If you look at the gold prices on the kind of run-up that we've seen with 40% gains, it has surpassed inflation-adjusted peak that we saw in 1980 there. Markets also are looking at higher prices from here on. So when you look at the latest reports that have come in the last couple of sessions itself, you have Goldman Sachs talking about $5,000 an ounce. There also is a report from Commerzbank overnight which says $3,600 an ounce of an average is what they're looking at in 25 and $3,800 as an average in 26. So higher highs from here and absolutely a possibility. But it's not just about gold as well, because with the dollar decline, we're looking at silver trading at a 14-year highs. Copper prices at around 15-month highs. Zinc is trading at the highest level since March 2025. And you have crude prices trading at a 2-week highs as well. So when it comes to tangibles, commodities, everything is trading in the positive right now. Of course, it is going to be the Jerome Powell speech announcement today in the evening that the street will watch out for. But you will also watch out for the Fed's quarterly summary of the economic report, the Fed's dot plot as well in the evening today. And the further cues would come in absolutely from this one.
Okay, all right. So the all-important Fed announcement awaited by markets around the world. Thank you for that, Manisha. We do have to take a very quick break. On the other side, our special segment coming up, it's the economy. Lata today speaks with the Managing Director of National Bank for Financing, Infrastructure and Development on the state of infrastructure financing.
Welcome to It's the Economy. NABFID, or the National Bank for Infrastructure Development, has increased its infrastructure sanctions tenfold from 40,000 crore in FY22 when it was formed to nearly 4 lakh crore. They have been lower at 79,460 crores after 4 years of operation. More importantly, NABFID is emerging as perhaps the only game in town for infra financing, with banks moving away and preferring retail lending. How will infrastructure finance evolve from here on? For this question, I'm joined by Mr. Rajkiran Rai, Managing Director of NABFID, formerly Managing Director of Union Bank, and a veteran, a watcher of the Indian banking scene. Mr. Rai, good morning. Thank you very much indeed for joining us. Well, first up, if you can tell us about your other activities. Sanctions at about 80,000 crores. Disbursement at about 80,000 crores, but in principle, sanctions are huge. Why is there such a gap?
Actually, we are a new entity. Actually, first we need to build a project pipeline. Actually, these are basically the sanctions. Actual sanctions are about 2.5 lakh crores. The remaining are in the process, basically. We need to build a robust pipeline and over a period of time, because infrastructure disbursements are spread between 1 to 3 years. So actually, as we go along, actually the balance sheet will grow much faster. Actually, we have to see that we are in the second year of full operations. So the disbursements will take time, but there is happening.
I agree with you. Why would you delay? But there is a large gap between sanction and disbursement. Is it that people take permission but are not able to get other permissions? Why is this lag?
Actually, when a project is allotted to a concessionaire, he has to get the financial tie-up immediately and get the appointed date. And then there are a lot of approvals. So even the quickest is between 6 to 12 months. So from the sanction date to first disbursement.
Well, I wanted to know about the other tasks that, NABFID wants to do. Primary among them is, credit enhancement. Now the Reserve Bank has eased the rules of credit enhancement. Haven't you all given any credit enhancement whatsoever?
No, actually the guidelines came recently. After that, we are launching the product because we have infra conclave tomorrow. We'll be launching the product. After that, we are in touch with the rating agencies. So we should see the first bond issuance and the credit enhancement somewhere in the third quarter now. So we are actually launching the product, and then actually, once the industry accepts it and when the ecosystem accepts it, then it will it is a huge, potential actually. About 4 to 5 lakh crores of potential of credit enhancement is available in the system.
Okay, but when do you think you will do so much credit enhancement? What is your target for, say, June 2026, or 1 year down?
Yeah, actually, we will be only the catalyst for this. Actually,
yes.
We will start because all the regulatory entities can do that. Actually, we are the leaders in this, and we will do the first few issuances. And we hope by that time other players in the system will understand the product and will get in. Because actually, we may not have the capacity to do 4-5 lakh crores. We may do maybe 50,000, 60,000 crores in the first 1 to 2 years, and then help other players to ramp up the operations.
Okay. When will your first partial credit enhancement happen?
It is in the process, so maybe next 30 days.
Oh, okay. Mr. Rajkiran Rai, you have been a banker for, 4 decades. You wear a banker's hat and tell us, why are banks not very enthused by infrastructure? Just everyone wants to do more corporate lending. At the most, they go up to MSME lending. Corporates don't want their money. But infrastructure, we don't see banks.
Yeah, this is something actually we need to fix. Actually, if you look at the whole exposure to the infrastructure sector, it's about 33 lakh crores. And out of that, the scheduled commercial banks are around 13 lakh crores. And last 2-3 years, we have not seen much growth. And the NBFCs and NABFID and, these players have added, actually, they are growing at double digits. And 19 lakh crores is their share in this infrastructure book, actually. So the banks have to really ramp up, and this is a very good potential. Actually, we did a study last year where we said that the defaults in the last 3-4 years is only 1%. And this year, we'll be surprised, the default is hardly 0.3%. So this is actually a good area, very stable area. Banks have to get in, in infra play. So because their credit growth is also suffering. So I think infra offers a better opportunity for the banks to come in and increase their exposure.
Are corporates not interested? I mean, today there was news that L&T has written to the government of India and the Andhra government to, I think, Telangana government to take away the Hyderabad metro from them because it is making losses. Now, if private sector gets hurt every time it dips its feet in infrastructure, there will be a reluctance, won't there? So is private sector, I mean, other than the Adani group, we don't see too much of people coming forward to dip their feet in infrastructure. Is there a problem there?
And generally, one-off projects like this actually drag the mood down in the sector. So compared to one metro of Hyderabad going down, you have attracted 7 lakh crores in InvITs actually, where the foreign pension funds, insurance funds are investing and buying assets left and right, both on the road sector and all that. We need to look at the positives actually. So the sector is doing well. Yes, metro was never commercially viable that way. We need to structure it differently because, see, that's why the play of infra is very specialized. Every sector is different. Today, look at the renewable sector. We have added almost 30 gigawatts last year and everything comes from the private sector. So much money has flown in. Like look at the InvITs which are in the road sector. 7 lakh crores of AUM expected to be 25 lakh crores by 2030. Just imagine the kind of money flowing into these sectors.
Okay. What about insurance companies? You remember last year when you did this convention, we had a discussion in CNBC-TV18 itself with insurance and pension funds. And you told us that they can put up to 15%, but they're all sitting at 9.5%. Has it improved?
No, it has not improved. Actually, the credit enhancement what we spoke about is a product actually designed for them. Because one of the issues with the insurance and pension funds, because they don't have the capability to assess the credit risk actually. While the commercial banks are very good in credit risk assessment. So that is where the credit enhancement comes in. Because the credit risk is underwritten by scheduled banks, actually, the regulated entities, and then the insurance and pension come with the investment. That is what we are working on, because we need to connect these two. For India, we have a lot of domestic money getting parked in insurance pension fund growing at about 15%, and they don't have investment avenues. Actually, the GSECs are not giving the returns what they generally typically get. So this is a sector they have to come in. So if they have to improve their returns, so by underwriting a credit risk, that is like a first loss guarantee by way of credit enhancement. Now it's the time the insurance and pension can come in and invest in like infra bonds.
Okay. You know, if you look at the GSEC rates, if you look at 10-year, it is 6.5. But if you look at 30-year, and many of the infrastructure projects are 30-year, it is going at 7.3, sir, as of now.
Yes.
Or 7.25. So for infra, they will want a spread. At 8%, is it viable? If they gave picked up infra bonds at 8%, I don't think y'all are interested, are y'all?
No, actually, the credit enhanced bonds, which are AA rated, should give them a return of upwards of 8.5. So this is a very good return, actually.
So you are expecting this to get floated when? A credit enhancement product for infrastructure companies because they are the guys with the money.
Actually, we have picked up some of the companies and where the credit enhancement process is on, actually, because we need to talk to rating agencies, what is the enhancement needed to move them from A to AA, AA plus kind of thing, which is in the process. So I said that, in next 30 days, we should be doing the first credit enhancement and then launch the bond.
Okay. And finally, global savings, you have in your investor presentation mentioned that, you all are speaking to a lot of global multilateral banks, World Bank, Asian Development Bank, New Development Bank, and the AIIB. Any progress? Should we hear joint financing?
Actually, one of the big multilateral is coming in the credit enhancement as a backstop. Actually, it is in the process of final approvals. That should reduce the cost of credit enhancement for all the players, actually. That is something which is happening. We are also trying to get into GIFT City for the equity and the blended finance part. We have already got the Environment Ministry approval to be in the GCF. So international accreditation process is in progress. We should be able to attract a lot of GCF money because NAFID is well placed, actually. Particularly, you need to have your governance system, credit assessment proposal, like assessment, complying with the E&S, to fulfill the requirement of the GCF funds. So NAFID has put in place all these mechanisms. So we should be able to attract like GCF funds, maybe through the GIFT City, which will help in blended finance. And also we are working with another multilateral for getting into the equity side also, because these are all our developmental agendas. In addition to the credit enhancement, sanction of credit, we will also get into the other space, which is very much required. Okay. Because kind of the infra play we are looking at 130-140 lakh crores in the next 5 years. There is equivalent capital equity requirement also. It is not only the senior debt.
Got it. So I'm completely out of time. Just give me two numbers. How much do you think NABFID will finance by, say, FY27? I'm giving you 2 years for a guess. And how much do you think Indian infrastructure financing will grow to in 2 years? Just give me two numbers.
Yeah, India infrastructure finance will grow between 10 to 12% actually. NAFID balance sheet actually, like that is the outstanding book, will be 2 lakh crores in 27.
Oh, 2 lakh crore. Now 79,000 crore, right?
No, it will be 2 lakh crores, yes.
Okay, that's a fairly strong growth. All the very best, Mr. Rai, and for the convention on infrastructure financing that you'll have organized for tomorrow. Thank you very much. So much. Thank you very much for giving us a curtain raiser. With that, we wrap up on this edition of It's the Economy. After a break, time for Chartbusters.